Tonight, we're tracking a story with profound implications for every American and the global economy. It's not about missiles or warships, it's about money. China has just dumped $688 billion in U.S. Treasury bonds. This isn't a quiet portfolio shift. It's a thunderous declaration of financial independence. The world's economic bedrock, Chimerica, where China funded U.S. deficits, has been shattered. China is systematically dismantling a financial relationship that defined the 21st century. The implications are enormous, a direct challenge to the supremacy of the U.S. dollar and the stability of the American economy. Who will fund America's spending now? At what cost? These are urgent, real-world problems for policymakers. Beijing's message is clear. We no longer trust you with our money. The shockwaves are not just financial, they're geopolitical. This is a power play on the global chessboard, designed to reduce China's vulnerability to U.S. sanctions. The era of comfortable economic interdependence is over. We are now in uncharted territory, where the rules are being rewritten in real time. The stakes could not be higher. Unlike military maneuvers, this financial move is permanent. Selling off nearly $700 billion in assets isn't a gesture you can reverse tomorrow. Military actions are like heated arguments. This is filing for divorce. China is building an economic fortress, preparing for a more hostile future. This sell-off reveals China's true intentions to insulate itself from American financial leverage. Repatriating and reallocating hundreds of billions is a one-way street. Washington is deeply concerned because this isn't a negotiating tactic, it's a statement of fact. China now sees U.S. debt as a liability, not a safe asset. By selling, Beijing removes a key point of leverage from the table. It's a quiet, strategic move with consequences far more lasting than any military standoff. The world has changed, not with a shot, but with a closed ledger. To grasp the scale, look at the numbers. At its peak, China held over $1.3 trillion in U.S. treasuries, America's largest foreign banker. Over the past decade, China has quietly reduced its exposure. But in the last 2 years, the pace accelerated, $688 billion offloaded. That's more than the annual output of Switzerland or Argentina. The U.S. Treasury data shows China's holdings plunging to the lowest level in over 2 decades. What was once a gradual reduction is now a sprint for the exits. This rapid liquidation puts immense pressure on the U.S. Treasury to find new buyers. It's a race against time. The message to other central banks is clear. If China no longer trusts U.S. debt, why should anyone else? This crisis of confidence could reshape international finance for decades. The world is watching and reacting. The future of global finance hangs in the balance. Why now? For Beijing, this is about national security, not market returns. The catalyst: the U.S. freezing Russia's reserves after the Ukraine invasion. China realized its own U.S. assets could be seized in a crisis. Their trillion-dollar war chest could become a hostage. The weaponization of the dollar changed China's risk calculation. The new goal: minimize geopolitical risk, not maximize returns. The order de-risk and sanction-proof the Chinese economy. The Great Sell-off is the most visible result of this doctrine. Tensions with the U.S. are rising, and Beijing is preparing for the worst. This is a massive insurance policy against American economic warfare. China is proactively preparing for what could happen next. Where is China's money going? Into real, tangible assets outside U.S. control. The primary destination: gold. China is now the world's largest official buyer. Gold is immune to sanctions and holds value across borders. China is also ramping up domestic gold production and encouraging citizens to buy gold. But it's not just gold. China is investing in commodities like oil, copper, and lithium. It's buying farmland, ports, and infrastructure worldwide. Each investment moves wealth out of the U.S. system and into assets that bolster China's security. This is a fundamental challenge to the global financial order. China is pioneering a model where national wealth is stored in hard assets, not just financial paper. It's a patient, far-sighted strategy for a new kind of economic power. With China gone, who's buying U.S. debt? America's allies, Japan, the UK, Belgium, are stepping in. But they're not buying for profit. It's political necessity. Japan props up the Treasury market to protect its own reserves and U.S. security guarantees. European allies buy to shore up the Western system against Russian and Chinese threats. These are geopolitical, not economic calculations. This creates a fragile foundation for the U.S. debt market. The old system was self-sustaining. The new one is based on political loyalty. If an ally faces crisis or a relationship sours, U.S. debt is at risk. America now depends on the goodwill of its partners. A precarious position. Allies are subsidizing U.S. borrowing while facing their own challenges. This arrangement is unstable and cannot last forever. It's a temporary patch, not a solution. The underlying problem remains unsolved. The U.S. financial architecture is more vulnerable than ever. This isn't just geopolitics, it hits your wallet. Fading demand for U.S. debt means higher interest rates. Mortgage, car loan, and credit card rates all rise. Higher borrowing costs slow economic growth and threaten jobs. Market volatility can erode retirement savings. A weaker dollar means more expensive imports. Electronics, coffee, gas. Inflation squeezes household budgets and reduces purchasing power. The era of cheap goods and low rates may be ending. The global system relies on U.S. treasuries as the world's risk-free asset. If confidence falters, a global financial crisis could follow. Emerging markets could default, spreading contagion worldwide. No one is immune to these risks. The U.S. debt market is shifting from economic logic to political loyalty. For decades, U.S. treasuries were the safest place to store capital, bought for self-interest, not as a favor. Now China is a strategic seller, and allies are buying out of obligation. This is dangerous. Economic interests are stable, but political alliances are fickle. Relying on loyalty is like building on sand. It might hold, but it's unstable. If an ally pulls back, the U.S. could face a sudden buyer's strike and a crisis of confidence. The U.S. economy is now vulnerable to the shifting priorities of its partners. The Federal Reserve may be forced to print money to buy government debt. This monetization risks runaway inflation and currency devaluation. The shift to political buyers pushes the U.S. closer to a financial precipice. Policy options are shrinking. The risk of a severe economic crisis is rising. The foundation of U.S. financial power is eroding. So, what should you do? Recognize the game has changed. The era of financial certainty is over. Volatility is the new normal. Diversification is key, not just stocks and bonds, but across asset classes, currencies, and geographies. If U.S. treasuries are less reliable, look at assets outside that system. Consider real assets like gold and global investments. Tangible assets like real estate can provide stability. Build a resilient portfolio not dependent on a single currency or government. Stay informed and be ready to adapt. The decisions in Beijing and Washington will impact your financial future. The tectonic plates of global finance are shifting. The age of vigilance has begun.